corner. The announcements of the Q4FY2023 financial results of the listed tech companies is just round the corner. We thought this is the right time to talk to analysts who are tracking the industry growth and learn from them what they foresee in the Q4 results and also their analysis and outlook for the next year. Today, I have Rishi Jhunjhunwala, Senior VP from IIFL Securities, who has over 20 years' experience tracking the technology sector at various levels. Thank you, Rishi, for taking time out to talk to nasscom, and welcome.
Thank
You
you
are
so
our
much for
first
giving me
guest.
the opportunity.
Great. So I'll quickly jump into the questions. So Rishi, it has been over a year since the inflation, macro and geopolitical headwinds surfaced, with some of these upstream segments of the tech ecosystem like internet or software flagging off on demand. However, according to the published strategic annual report, we estimated that the tech industry will register reasonably strong metrics with growth moving to pre-COVID levels. So, upfront, I would just like to understand what is your expectation for this quarter in terms of revenue and margins, and also if you can give a bit explanation around the currency fluctuation impact that can affect the growth numbers. Related to that, also, do you see any short-term or long-term repercussions of the recent global banking crisis affecting the industry? Over to you, Rishi.
Thank you. So two-part questions, right? So first on the quarter and its expectations. So see, seasonally, 4Q is typically a weak quarter because the budgets get finalized by the corporates, and so the spending starts picking up in the fourth quarter and then starts to ramp up in 1Q and 2Q. So in the same way, 4Q will be a seasonally weak quarter from a sequential basis. We have already seen deceleration in growth over the past 6 months or so, primarily because of the macro pressure that have arisen, not just in Europe, but of course in Europe, in US as well. And that is something which will impact growth rate in 4Q as well. So we are expecting for the industry as a whole to grow at sub 1.5% on a QOQ basis on a constant currency basis. Though because dollar had depreciated against most of the global currencies in the quarter, there will be almost like 150 basis points tailwind on a QOQ basis that the companies will see on an average. So overall growth rates might be closer to between 2.5 to 3% on an average. Supply side headwinds have started to ease off, and that is something which will be reflected in much lower attrition, lower hiring for the companies as well, which was visible in 3Q as well. But because demand has not picked up materially, we are going to see supply side providing tailwinds rather than headwinds and for the margins. And on an average, you will see companies witnessing about 40 to 50 basis points expansion in margins. And this is a combination of much easier supply side as well as some cross currency tailwinds related margin benefits also. As far as the impact from the regional banking crisis or the issues that are happening in US, this point of time the direct exposure to US regional banks seem to be limited for the Indian IT companies. On the flip side, the counter argument is that because the US regional banks are going to become weaker, a lot of the market share will shift towards the larger, more integrated banks, and these are bigger customers for the Indian IT companies, and as a result the impact on a net basis may not be negative, but in fact could potentially be positive in the near term. However, if the banking crisis impacts the overall macro because the regional banks support a lot of small and medium enterprises in US, so if there is a derivative impact on the GDP growth being slowing down, then that could potentially have some impact in the medium term from a tech spending perspective. But till that time, we do not see a material impact on ground coming from the current regional bank crisis, and we still have to see how it ends up unfolding over the next 6 to 12 months.
We'll have to wait and watch for the next quarter. How is it going to pan out, right? That's
Correct.
how the situation will be. It keeps changing every quarter.
Yes.
So you talked about hiring. Some of the things that we estimated that in our report that the industry will add nearly 250,000 people in FY23, which is considering all the hiring correction that happened across companies, right? So last quarter we also saw that the top five listed companies together recorded a dip in employee addition over the previous quarter. So you already mentioned that I think the same kind of situation is going to continue for Q4, but also we saw the attrition level stabilizing. So just wanted to check your what are your thoughts on the attrition levels, and also if there are any specific strategies that companies are following to hire retain their existing pool, because as everybody knows, talent is one of the most important asset and for any company today. So anything that you can share around that?
Sure. So as far as attrition is concerned, it is going to see a sharp slowdown in this quarter as well. You may, on an average, see 400 to 500 basis points reduction in quarterly annualized attrition rates across the industry. So attrition will probably come closer to where it used to be on a pre-COVID basis very quickly. As far as hiring is concerned, that also may remain muted at least for this quarter, primarily because companies had hired significantly more people in anticipation of growth remaining strong and the fact that supply side was very tight. They've also hired a lot of freshers last year, which will start becoming billable in this year, and as a result, a lot of the hiring needs will not be there. So what you will see from a strategy perspective is that the companies will potentially start looking a lot more at just-in-time hiring, the way they used to do on a pre-COVID basis as well, which will mean that the bench strengths will reduce, utilization will go up, all of which will be tailwinds for the margin as well. But on the hiring side, you will definitely see companies witnessing muted hiring at least for this quarter also, as well as attrition dipping sharply.
That's something that we used to hear before COVID, just in time hiring, and suddenly
Yeah,
it just picked up a lot. So you
yeah,
feel that that's going to come back again, right?
yeah, yeah.
Great. So some thoughts around the I had was around the any visibility around CY23 IT budgets. Is there any visibility, and also is it expected to remain normal like any other year, or will it be slightly lower versus the earlier last 2 years because of the macro slowdowns and all the headwinds that we are seeing?
Yeah.
Uh, any thoughts around that?
Sure. So at this point of time, the way it looks like is that definitely the budgets will be lower than last 2 years, right? So last 2 years there was a lot of pent up spend that had happened as companies were coming out of COVID and wanted to invest a lot more in technology to stay relevant. So this year, because of the macro pressures primarily, you will see that the budgets will potentially be slower, right, or lower than last 2 years. This is not necessarily a reflection of the ability or willingness of customers to spend on technology, but more, them taking a preemptive and precautious stance ahead of the macro pressures which continue to rise, and which is where we believe that as a result of that, while we may see some deceleration in growth in the next couple of quarters, we will see an equally quick rebound in growth as well by the end of this year. And as a result, the growth rates, while it may inch lower than high single digit or double digit in the during the course of the year, but we should see companies exiting the year back to close to double digit kind of a growth. That's what our expectation is from an IT spending trajectory perspective.
And any specific markets that you see this growth happening, or any color around that right now?
So Europe was supposed to be weaker because of the kind of crisis that is going on, but Europe is actually surprising positively till now. Even the December quarter was reasonably strong, and while companies had called out Europe being weaker through the course of CY23, it is not panning out as yet. So Europe might actually come out to be a surprise element when it comes to growth, especially through the course of the year, as Europe may show counter cyclical trends wherein, in order to save costs, companies might actually look to do more outsourcing, and
Trans-
as a result, it might prove to be stronger. US is something where, because of incremental issues coming up and which includes the recent regional banking crisis as well, you might see, slowdown happening now, a bit more, and then again, by the end of the year, things should start to normalize.
And in terms of deals that we are seeing, so last quarter we saw a few cost optimization deals picking up. So, do you see such deals moving faster in terms of decision making? What is it that will happen this quarter? Because it's something which has been going on for some time, but we don't know how quick it works out, right? And anything about the size of deals that we are looking at? Are they still the small size deals, or are we
Yeah,
moving to large transformational
sure.
deals?
So there are two aspects to it. One is that the nature of deals are again shifting from being digital front end transformation kind of deals, which are more focused on growing the business or change the business, towards cost takeout, cost efficiency, productivity improvement, back end transformation kind of deals, slightly more on the maintenance side. So we are clearly seeing a shift now towards that as macro pressures are increasing. That also means that as a result, the tenures will be probably larger. The size of the deals will again start becoming larger because these kind of deals are typically bigger in size. So in terms of total contract value, you might actually see companies delivering reasonably healthy deal wins as well in terms of TCVs. However, what is happening is that the decision making is getting delayed or getting erratic. So while there is a shift towards cost takeout, the decision making has become a bit delayed. So that is something which could impact the TCV announcements, say in 4Q, and some of it gets spilled over in 1Q. So that is the only reason why you might see some weakness in TCV wins for some of the companies. But otherwise, there is a clear shift from digital to cost takeout deals.
And in terms of the verticals or the sectors, which are the any specific sectors that you see, which has outperformed, or are they still before, just about when the COVID started, travel was one sector which was struggling a
Yeah.
lot. So, are there anything, are the sectors that you see growing, and also uh, what are the specific drivers for these sectors? I know that these will vary
Sure.
by specific regions or country, but anything that you share, and some emerging areas, are there any new verticals or sectors that we can talk about, or any pattern related to pre-COVID and now how it is panning out?
Sure. So the sectors that are currently facing pressures are, high tech, retail and CPG, and now to an extent BFS, right? Financial services, because of the issues that are cropping up both in US and in Europe. Whereas the sectors which are actually doing pretty well are travel and transportation, manufacturing, energy and utilities, and healthcare and life sciences. These are some of the sectors which are doing well because their underlying drivers still remain fairly strong. And that is a trend of these well growing sectors that we have heard from companies in the recent past based on our conversations also. So I think apart from financial services where there is some impact because that could potentially come because of some of the new developments, most of the sectors which are growing well are the ones which have been doing well in the last 1 year as well. Whereas retail, CPG, and um, high tech are some of the verticals which continue to struggle, and that is true across geographies, right? So it's not specific to US or not specific to Europe, but most of these are facing similar kind of drivers across geographies. As far as some of the new sectors are concerned, there is clearly a lot more momentum in sectors like healthcare and life sciences, which are relatively small for Indian companies, right? While some of the global MNCs do a lot of work in life sciences and healthcare, but Indian companies' the exposure to that area is not very large, and that is where we are witnessing these companies being able to gain market share and grow at a reasonably rapid pace. So that's a new area that one should watch out for. But otherwise, overall, the growth trajectory remains bipolar between in one on one side there is BFS, retail CPG, and high tech being troubled verticals, On the other hand, insurance, manufacturing, energy and utilities, healthcare, life sciences, and travel and transportation being the verticals which are growing.
Great. So travel has come back to the, I think, pre-COVID levels at least. That's what you're seeing now.
Absolutely, in a big way. In
Yeah.
a big way.
Yeah. Great. So, Rishi, to sum up, my last question is around the outlook for the industry. So, do you believe that once the near-term noise around macro inflation and all the headwinds is behind us, can growth rates again accelerate back to the double digits? And what kind of guidance can we expect for margins during the year, or maybe
Yeah.
specifically for the quarter? And another thing I wanted to understand was we spoke about deal activity. So any take on the growth of cost optimization deals and digital component in these deals? How is that going to grow?
Sure. So, firstly, on the outlook side, fiscal 23 was a good year for the industry. I think industry would end with growth at around 13-14%. We are expecting fiscal 24 to see some of the macro pressures, and as a result, there will be some deceleration. But we are still expecting industry to grow at 8 to 9%. Whereas there is a section on the street or in the consensus who expects a much slower growth rate for FY24 and are building in 5 to 6% kind of a growth. But we do not believe that the deceleration will be so sharp. And
This
that
is
is
in
something
constant currency.
on
This is in
constant currency.
constant. Okay.
Absolutely, absolutely. And that is something which, at least till now, the companies are also suggesting that the demand is holding up for most of them. But for this recent US banking crisis, the demand was reasonably holding up and was not deteriorating to a pace which will lead to mid single digit growth, but it was looking more like high single digit growth. So we'll see how things pan out eventually. We still continue to expect that industry this year will grow at 8 to 9%, and then from next year onwards we'll go back again to between 10 to 12% kind of a growth rate, which is now we believe is a structurally stable growth rate that the industry can potentially do for the next 5 years, given that technology has become a far bigger priority post the COVID pandemic. And the customers have repurposed or reallocated a lot of the other business spends towards technology. So long-term growth rates might still remain between 10 to 12%. This year there might be some slowdown that we are building in, and there is a section on the street which believes it can go even much lower than this. As far as deals are concerned, you will see, as I said, the overall, I don't think there will be a significant jump in terms of growth for deal wins at this point of time, given the uncertainty in the macro environment. But you will still see healthy deal wins being announced by the companies across the board, with a higher proportion coming from cost optimization deals, while digital deals will probably see slowdown. And that is something which we saw even in Accenture's results and their bookings, where their managed services or outsourcing deal wins grew at a much stronger rate, whereas their consulting deals actually grew at a pretty weak rate, right? So that is something, that is a trend which you will witness for the next at
Yeah.
least 6 months or so, and beyond that, I think things will start normalizing again.
Okay. And anything around the margins? Any view around the margins? How that will look? Any
So
guidance?
through the course of the year, you'll see margins expand for the company. So we are building in FY24 to be a higher margin year for the Indian companies versus 23. There was a lot of pressure on margins in 22 and 23 because of the supply side dynamics, but a lot of that is easing off quite considerably. You'll also potentially see companies announcing much lower wage hikes in FY24 compared to FY23, and there will be, as a result, a deflationary impact on cost per employee for the IT companies. So that will be a big tailwind in terms of on the margin side. So we do expect most of the companies in our sector to actually see expansion on margins in FY24.
Okay, so any last word around what you see the quarter four looking for the industry, and how optimistic are you for the overall next year? Anything?
Sure.
I know we
So
spoke.
while
Yeah.
Sure. So while quarter four is going to be around how macro will play out in US and Europe, so you might see companies going a bit conservative on the guidance that they might provide for the full year in FY24. And 4Q in itself is not a very strong quarter any which way. So the exit rates will not be that great. But we do expect that through the course of FY24, the both the outlook on IT spending as well as on the margins will continue to improve. And as a result, you will see improved commentary also from the companies as there is more visibility on how the spends are panning out.
Thank you. Thank you so much, Rishi. This has really been very insightful and useful, I guess. So, with that, we come to the end of this session. Do share your feedback with us. Don't forget to subscribe to our YouTube channel and community portal for more such insightful sessions. Thank you. Take care.
Thank you very much.